And I can tell you that our research shows that since Tesla's IPO in June 2010, 90% of Tesla's gains have come during 5% of the trading days. So that's just less than 13 days a year on average. Basically, you wake up every morning as a PM, and what you're going to find during the day is that Tesla is going to be either not doing anything or it's going to be down. And you better be there to explain to your clients, well, why do you own this company? It's not going anywhere. It's got all this headline risk. It's got management risk, presumably. Right? All of these things you have to deal with. Lost in that mess are occasions, like was the case of Tesla in 2020 when we bought it, when the earnings are artificially depressed because the company is investing so much in the business today, or at that point, to create a higher intrinsic value later. And the consequence of that is you depress earnings, P ratio goes up. People who haven't done the deep work, like your audience, look at it and say, gee, how can I pay 100 times earnings for an auto stock? And they just miss the whole thing. For me, that's the fun part, right? I like to uncover opportunities where maybe other people just haven't done the work because they're too lazy or they don't understand the situation. That kind of misunderstanding often happens in the world of growth companies because of that dynamic at play.
There are only a small handful of big whale Tesla investors like Ron Barron, Cathie Wood, and our guest today, Christopher Tsai, who really gets the company and who's been holding giant amounts of Tesla stock for many, many years. Why is it that only a select group of fund managers understand what it means to invest in innovative companies that disrupt massive markets? Christopher is the founder and chief investment officer of Tsai Capital. He's a third-generation investor, as his grandmother, Ruth, was the first woman to trade shares on the Shanghai Stock Exchange, and his father, Gerald, was a legendary investor who ran the Fidelity Capital Fund, then the Manhattan Fund, and later became the CEO of financial services giant Primerica. Tsai Capital is an investment management firm dedicated to preserving and growing capital for select families and organizations over the long term. The firm has outperformed the S&P 500 index over the past 25 years by investing in exceptional growth companies that have a durable economic moat, the ability to reinvest capital at higher rates of return over long duration. Welcome, Christopher. Thank you so much for joining me today.
Hi, Herbert. It's great to be here. So excited to be here with your audience.
I appreciate you. You are somebody I've been following for a long time. And I regard you to be somebody, like Ron Barron and Cathie Wood, because you're very similar. You guys discovered Tesla early, and then your goal is just to hold on, despite all the things that are happening. Can we start off with what is your Tesla investment? What's your thesis? Why do you like Tesla?
Sure. Well, first off, I did discover Tesla early. The mistake I made was not buying it. So I waited a little too long. But we love businesses that have a deep competitive advantage. That's, something that a lot of investment managers talk about. But we also like businesses that are misunderstood, particularly when it comes to valuation. So I had been studying Tesla for a number of years prior to investing. We made our first investment in February of 2020. And we'll get into this, but February 2020, from a valuation standpoint, was kind of similar to today. And so we'll dive into that. But what caught my attention was right around that time, the company turned profitable. So we don't like to invest in unprofitable businesses. We'd rather just wait until they prove themselves out, de-risk the situation a bit, even if we have to sacrifice some upside. So we waited. We could have bought it earlier, of course, at a lower price, but it's our strategy to wait a little bit, wait for that profitability. February 2020 comes around. The market gives us an opportunity. The thesis back then is very similar to the thesis today. So to answer your question, we love businesses that have really deep economic moats. First off, that could manifest itself in various ways. One of those moats is pricing power. Another moat is the ability to manufacture at a cost that is much lower than anybody else. A third moat might be the company's product, right? You have a superior product or service. And often not talked about, you mentioned Ron Barron. Ron spends a lot of time actually on companies' culture, what makes a company tick. And how is it unique? Tesla's had a very unique culture from pretty much the beginning. And it's not so often you get, a few million applications for a few thousand job slots. It should tell you something. So these elements that underpin a moat, and those are just some of them, they existed back then in February 2020, and they exist today. And they're even stronger today. So these are some of the things that attracted us to the business. The second part of the equation is with any company that we look at, we love businesses that have a durable long-term tailwind, the ability to reinvest capital at high rates of return over a very long duration, and unit economics that are truly stellar. So when I'm talking about unit economics, I'm not talking about CAC, which is the customer acquisition costs, or LTV, long-term value, or lifetime value. I'm talking about something more granular. So if you think about a company like Coca-Cola serving Coke, how much does it make per serving? Mm-hmm. In the case of Tesla, and we'll dive into that later, we're looking at some other metrics, such as how much is it making per factory, how much is it making per car, how much is it making on a megapack, and so forth, and how does that scale over time? So that's the second element. So Herbert, so you asked me, what attracted us, what's the thesis behind it? So these are some elements that we require in all of our investments. But the one that's really interesting to me is something perhaps not spoken about so much. So when I look at companies, I'm looking at them from multiple angles. And I'm a huge fan of mental models. So it was the year 2018, I think, I first met Charlie Munger. And Charlie, as many of your viewers know, is a huge fan of mental models and applying them from different domains, chemistry, physics, biology, to the world of investing. There's one mental model that comes from biology that I think is pretty cool. And we look at this mental model and we try to make sure that our businesses kind of fit within that framework. That mental model, you can think about it in biology as like a symbiotic relationship, also known as mutualism. So the clownfish, right, and the sea anemone. Mm-hmm. So the sea anemone has these poisonous kind of tentacles that it uses as a defense mechanism, so it keeps other fish away. But the sea anemone, the clownfish has this kind of like mucus coating that protects it from the tentacles. So the anemone provides protection for the clownfish, and the clownfish in turn gets it provides some food to the anemone by its dropping of food. It cleans the tentacles. It actually aerates the water by moving water around and provides oxygen-rich water to the anemone. So this is a symbiotic relationship going back 10, 20 million years. Basically, it's a long way of saying we look for win-wins. In fact, we look for win-win-win relationships in the world of business. Translating all of that into the world from biology into business. It means that we're looking for companies that take care of their community, right? Their customers, their suppliers, their shareholders. All of these things create a win-win dynamic. And the win-win dynamic is so important because, like in biology, it creates a very durable economic moat. And we come full circle back to this idea of how do we ensure that if we've got a great business and we want to compound that capital over long duration and high rates of return, how do we ensure that that foundation will remain in place over time? One of the ways is to make sure we have some sort of mutualism. So that's the other element with respect to Tesla and the other 20 plus businesses that we own. That's so important to us.
I love that you went in detail how you look at and what metrics you look at and why. But it's very refreshing to hear somebody like you to explain this, but also that it's what is your time frame? What's your time horizon? Because all of this you just talked about is it means to me that you're looking at a company for the long term, not just, you're not trading it over the quarter. You're not doing, I don't think you're doing options. Are you maybe on the edges? What is your time horizon when you do invest in a company?
Because I'm not smart enough to be able to,
Sure.
decide that I need to buy here and sell here in a month or two or a day later. Um, I think that you get an advantage as an investor by kind of zooming out, thinking about, what's the ultimate game plan? Like, where are we going here? Uh, and thinking long term. And so when I look at a business, I go in with the attitude that we're going to own this company for 10 years or more.
10 years or more. Okay.
That's the attitude. You want to start with that attitude. Of course, if fundamentals change, if situations change, then we'll make an adjustment. But I think it's important to have that attitude.
Yeah, that's fantastic. Again, it's like, that's why I think Ron Barron, Cathie Wood, you have just so few. The rest of them are quarterly. Here's what my 12-month target is, and I'm going to, rate it a buy or sell every friggin' month. They change it. So I was curious when you said that you see Tesla, you described exactly what it was when you first decided to invest in 2020, but then you said that it feels like it's very similar right now. Are you expecting a big jump soon? And what is it about right now that's similar to then?
One of the things I learned, you mentioned my dad early on. He was a really interesting person because he was in many ways, a pioneer in the 1960s when he would, he built Fidelity Capital Fund. He was a major owner of Fidelity Investments. But what he did was he bought stock in size. We call it block trading. And he did it with his friend, John Rosenwald, who became vice chair of JP Morgan, among other things. And actually, John Rosenwald introduced me to Ron Barron. That's my connection to Ron Barron. Gotcha. But they shook things up, and they, my father in particular, thought about companies in terms of growth. You have to understand, like back then in the 1950s and 60s, what you did was you bought a utility company, for a trust company. You bought a stable company. And here he was going out and buying growth companies that had seemingly high price to earning ratios. So why do they have high price to earning ratios? Some of them had high price to earnings ratios probably because they had no earnings and they never would have any earnings. But that's besides the point. Lost in that mess are occasions, like was the case of Tesla in 2020 when we bought it, when the earnings are artificially depressed because the company is investing so much in the business today or at that point to create a higher intrinsic value later. So investing now will reduce earnings, make the price earnings ratio look higher than it might be, but that investment might increase the intrinsic value of the company. So a good analogy would be, or to think about this, is that when Warren Buffett bought Geico, he penalized the company's earnings shortly after he acquired Geico because he decided that the unit economics of that business were so strong that he wanted to invest a lot more money, right, to create a higher intrinsic value later. Had that company been a publicly traded company, probably would have gone down, right? And people would have said, oh, it's way too expensive for an auto insurer. Yeah. So similar was the case in February 2020 when we bought Tesla. It was investing so much in the business. It had just turned profitable. And I think that we are in a similar situation today, Herbert, because we are investing in this business, right, to build a higher intrinsic value later. The economics are so great in multiple verticals. Now is the time to make that investment. And the consequence of that is you depress earnings, P ratio goes up. People who haven't done the deep work, like your audience, look at it and say, gee, how can I pay 100 times earnings for
Yeah.
an auto stock?
Yeah.
And they just miss the whole thing. So for me, that's the fun part, right? I like to uncover opportunities where maybe other people just haven't done the work because they're too lazy or they don't understand the situation. That kind of misunderstanding often happens in the world of growth companies because of that dynamic at play. So I didn't answer your question specifically about
Yeah, what is it now that you said, but you see that they're investing in the future businesses?
Yeah. So it's really interesting. So we have a lot of data on Tesla. We obviously do a lot of work on Tesla. And in February 2020, I'm pulling up my little cheat sheet here. So in February 2020, they did 20.8, excuse me, in 2019, they ended the year with $20.8 billion of auto revenue. That's 2019. They ended with 20.8 billion of auto revenue. And last year, 2024, they ended with 77 billion. So that's, from 19 to 2024, it's, 5 years forward, right? That's 3.7x. Okay. And then more interestingly, though, this company tracks operating cash flow, ex regulatory credits, pretty closely. They did 1.8 billion of operating cash flow in 2019. And in 2024, they ended the year with 12.16 billion of operating cash flow, ex regulatory credits. That's a 6.7 times increase. Mm-hmm. So we bought the stock just after the end of 2019, and the stock is up, guess what? About 6.7 times. Almost exactly in line with the growth of operating cash flow. So businesses follow, the stock prices follow underlying fundamentals, over time. And there might be periods of disconnect, but over time, the stock price follows the underlying fundamentals. And the fundamentals are up 6.7 times in this regard. And the stock is up roughly 6.7 times. So when you step back, especially recently with all of the negative news on Tesla, right? Almost every article you read looks like there's something wrong, right? But in fact, the business is growing. Yeah, just because you don't have sales, in 1 year go up 20-25%, doesn't mean that our CEO isn't creating intrinsic value for all of us. And so that's very important to keep in mind, to zoom out what's happening to the business versus what's happening to the stock price. Over the long run, you'll see that the stock price will track the business very carefully. But over the short term, can be this huge disconnects, especially in the case of Tesla. So today, we think that based on evaluation, normalized from all of this investment going on today, relative to 2020 when we bought the stock, normalized from what's going on back then, stock is roughly at the same valuation. Mm-hmm. That's my point. Yeah. So it's increased 6.7 times, but the valuation is roughly similar. And I'm not talking about simple optics, what you can screen for, like PE and price to sales. I'm looking at the underlying fundamentals. What's the stable rate of the earnings of the business today? What was it back then? How does that compare with the valuation? You need to do deep work to get at that. It can't be screened for. So I'm really excited for all the Tesla owners who are watching this show, because I think that we are in a similar setup to when we bought the stock. We paid $41.66 a share on average initially. Mm-hmm. And we think the valuation was really, really, really compelling back then. But today, it's also really compelling.
Do you do price targets, or do you have a forecast of what you think the price will be in 5 years from now or something like that?
We have internal forecasts that I often don't talk about publicly. Once in a
Mm-hmm.
while, I've mentioned some ideas on Tesla and some other stocks, but generally, I don't talk about price targets specifically with respect to companies like Tesla because they're dynamic. I think more in terms of what the base case internal rate of return is for an investment. And I try to get that at some sort of discount, call it 20% or more to whatever the stock is selling for. And then I think about optionality. So, there's a
Gotcha.
economist Keynes who said, I'd
Yeah.
rather, or paraphrase him, I'd rather be approximately right than precisely wrong. That's how that's how I
Gotcha.
think
Gotcha.
about Tesla. Like we want to be
Yeah.
invested,
Yeah.
especially now. I have an idea of where I think this business will compound, the underlying business. I have an idea of where I think the stock will move in terms of an internal rate of return. But I've also purposely not included some elements that can surprise on the upside. So
Okay.
I'm creating some like free optionality. If it works out, it's great. If it doesn't, we're still going to be okay.
Okay. I understand now who you're sitting here. I mean, Cathie Wood, though, obviously did their research and they put out price targets, right? $2,600 by 2029, mostly on Robotaxi. They didn't include robots yet. They researched that, they mapped it out. What's your belief of her estimate, maybe, or your own? I know you treat it like an optionality. If it works, great, but still, you believe that your analysis shows that you'll at least get 20-40% increase anyways. But what's your thinking about Robotaxi?
Yeah. So first of all, I'd say that Cathie has a very good team of people who are doing deep work, and Sam Koros is a dear friend of mine. I'm actually seeing him on Monday, and I would think Sam knows a lot more about how to get to his price target than I ever would, and so I don't compete like that in terms of trying to get to an exact number. We're running a portfolio of more than 20 companies, but it's allocated as a bell curve. So our top 5 positions are pretty substantial relative to the portfolio. Call it our highest conviction ideas based on
Tesla's number one. Yeah.
Tesla's number one. Tesla's number one by far, and so I'm looking at obviously, where's capital best allocated, and it's not necessarily based on price targets, but it's also a function of the quality of the business, our understanding of the business. So it's a little bit different if you were to just name one stock.
And thoughts on Robotaxi?
Really interesting. Going back to how we think about any business. So I mentioned Coca-Cola.
Right.
And in the case of Coke, you're thinking about like profit per serving, right? In the case of a company like McDonald's, which we owned years ago, we did a lot of work on how much were they making per company-owned site per share.
Yeah.
How much were they making per franchise site per share? And then we broke that down domestically versus internationally and did a deep dive on how the business was moving. So you could kind of see internally what was going to happen to the profitability of the business. So Robotaxi is when you start doing the numbers as you do for Optimus, right? They can get really, really silly in a good way. So the way I think about modeling out our projections is to have a purposeful flaw in the numbers. So we purposefully skew our numbers in a conservative manner. So what I'm going to tell you about how I'm looking at it doesn't necessarily mean it will pan out that way. And many of your viewers might think I'm being way too conservative, and I probably am. Yeah. But that's also intentional. So this is how I'm looking at Robotaxi. 50,000 revenue miles per unit. I think that's a good approximation. I've seen credible arguments why it can't be 60 or 70,000 revenue miles a year, but we're just use 50,000. Okay. We're thinking about 50 cents a mile of revenue, which is probably on the low side. So that's 25,000 per car per year. But we are a little bit perhaps more optimistic on margin than some people. And from a net profit, I'm not talking about gross margin, from a net profit margin standpoint, we think that 40% is reasonable for this business. So if you take 1 million units, we can ramp to 1 million units fairly quickly. You take 1 million units at 50,000 miles a year, 50 cents of revenue a mile, or 20 cents of profit per mile. Mm-hmm. That's that 40% margin. You get $10,000 of profit per car. Mm-hmm. So that means a few things. First of all, 10,000 profit per car net per year net means that if you spend, call it 30,000 on a Robotaxi to manufacture it, probably lower, mm-hmm. but let's just make it easy. Say 30,000. That's a 33% IRR on that business from day one, without anything else that we don't know about. Could be advertising revenue as you're sitting in the back of your car watching Netflix, or it could be a lot of different things. We're not even modeling that. So it's $10,000 of profit per car, and there's no reason why they don't scale quickly, and why we're not in the millions of vehicles over time. So let's think about just 1 million vehicles. So 1 million vehicles at 10,000 per car means $10 billion of net profit. So what does $10 billion of net profit mean? Well, we kind of thinking about Tesla long out with a terminal multiple, by the way. Not sure I mentioned this to anybody before, but longer term out, I'm talking like 15, 20 years out, we're probably thinking about Tesla as kind of like a 30 multiple kind of company, 3x revenue kind of company, very similar to Apple, like 3x revenue, 30 multiple, 10% net profit margin, probably be higher on Tesla, but they may do other things which then compress the margin again. But let's just assume a 30 multiple on that mm-hmm. 10 billion of profit for each 1 million Robotaxis. That's 300 billion of market value. Mm-hmm. So 300 billion of market value equals 1 million Robotaxis.
Yes.
And you're getting the business at a little over 900 billion for the whole company.
The whole company.
So, but that doesn't show up in the PE, right? It doesn't really show up in the earnings now, because again, the company's investing now to create a higher intrinsic value later. And so you have all these people who don't do the deep work like your audience, and they just look at the PE multiple and they dismiss it, right? They don't even go there. And we're going to talk later about that when we talk about how maybe we can talk a little bit about how institutions think about Tesla.
Yeah, I want to ask you questions on that. This is
that
great.
That relates right in.
Yeah, I love that you shared you're thinking of Robotaxi. So you do have your own model, but like you say, like you're being very, very conservative, but I don't think you are. I mean, I know you are, but I like your numbers. I like your numbers a lot. I mean, 10,000 miles. Sorry, how many miles did you say per year?
50,000 revenue miles.
50,000 revenue miles is 5 times 10,000, and I think that's more than enough. Like, I don't think that a Robotaxi, like some people think it's going to be used 24 hours a day. Of course not. Even, I think 12 hours a day is fine, because at nighttime there's less rides, unless they actually find a way to deliver products during nighttime, which is what they are hinting at. So this is good numbers.
For sure. And also, the flip side of that is the more efficient a Robotaxi offering, you actually need less vehicles on the road. Yeah. So there is an offset, but we are coming from a very, very low starting base. So I'm just thinking in terms of, what each million
Just what
means.
each million. Yeah. And so what's your thinking about
Make it
million?
easy.
When might you think that they would get a million cars out there?
I think we're looking probably a little bit further out than most people might be modeling, but not that far. It's
Mhm.
not like we're gonna we're gonna be old. It's gonna happen. It's gonna happen, and it's gonna happen. I would think within 5 years or so that we're gonna
Mhm.
be well at that scale, and at that point growing very very quickly. So we're not going to stop at a million. I want to make that clear. It's just the world is too big.
Yeah. Your conviction on Robotaxi sounds very, very strong. Like I didn't hear a single doubt in your mind here. And then, especially, of course, that's just changed in the last couple of days here, where we've got movement on a federal framework
Yeah,
for
exciting,
autonomy.
right?
Got FSD approved in Norway. Of course, still Tesla employees, but hey, this is Europe, and there seem to have made movement there. Of course, all the things we're hearing about FSD in China, just using FSD on a regular basis, and then of course them confirming that June is happening. So all of this seems like it's headed in the right direction. But you've did you always waver? Did you ever waver on it? Was it, like you said, you treat it like an optionality anyways. So you kind of, yeah, you didn't bank on it, is what you're saying, right?
I'm not banking on it today either, just to
Mm-hmm.
be clear.
Yeah.
This is all optionality. I like the existing auto business with a software overlay that has the potential to generate 70% or so operating margins. The business is clearly, scaling very, very quickly. So I think about the cars on the road like this guy, right?
Mm-hmm. Yeah.
It's an install base.
Yeah.
And we're going to sell increasing amounts of services on the installed base. So I'm actually very happy with the company's valuation today based on that existing business. And I consider and obviously the energy business as well is part of that. So I consider Robotaxi and I consider Optimus and any other potential vertical as optionality.
There's like a few portfolio managers, fund managers who are saying they're vocalizing their disappointment with this potential more affordable cars. They've been harping for so long. It's got to be a compact car in order to break open the TAM, in order to grow the volume of sales. If it's not a compact car, it's not good enough. What's your thinking about these more affordable cars?
I'm all in favor of introducing a more affordable option, and I don't see any reason to think that the business is not moving there over time. So I'd like to take the conversation for just a second back to where we started off.
Mm-hmm.
What's attractive to us in a company? What's attractive in Tesla? I mentioned moats. I mentioned ability to deploy capital at high rates of return over long duration. Mentioned this win-win framework. Let's dive a little bit into the win-win framework and then bring it full circle. So win-win frameworks are not just sea anemones and clownfish, right? They are frameworks that benefit the consumer.
Yeah.
There are a few businesses that operate with what Nick Sleep, the fund manager, coined scale economies shared. They have a scale economy shared business model such that as they grow and they themselves get economies through scale, they don't pocket the entire margin of savings, but they pass it on to the consumer in the form of either a lower price, better product, or a combination of the two. Good examples are Amazon, Costco, and still, for some very bizarre reason not spoken about, is Tesla. So Tesla fits directly within a scale economy shared business model. And that's why you've seen over time the price of the car come down at a pretty rapid rate, like really rapid, more than 15% compounded over a long period of time. And the effect of that is to then drive this flywheel where you can sell more vehicles. The competition, which is already losing money head over fist, gets into an even more difficult situation, and then Tesla can just take that capital that they're earning and reinvest in the business, and then continue to drive the flywheel so that they can push prices down. That's how That's the model that's been in place for years, and there's nothing in my mind that's changed that playbook. So we will get an affordable model simply as a result, a more affordable model simply as a result of an intentional scale economy shared business model that was first introduced, by the way, by Henry Ford.
First of all, I love this discussion with you, Christopher. You get it. I keep comparing you to other portfolio managers that we've been speaking to, and they are so upset that Tesla did not keep their price of their car high. And they kept saying, what a mistake it was for making those price cuts because it never translated to increased TAM. And they are so upset that their margins, declined from 30 plus to now, oh my gosh, 16%. How dare they reduce the margin? But they didn't understand the things you just said now. It's just so frustrating sometimes. And of course, they didn't understand that if they kept the price that high, you can't sell the car at that price point. But we're talking about post-COVID. We're talking about, recessions and the market economics we just went through, and we still are high interest rate environment. So you get it. Before we move on to other segments here, what's your thoughts about Elon Musk? That's another big thing that portfolio managers seem to get. The thing now we're hearing is people screaming, saying Elon should get out of Doge. Look at the political damage he's made, the brand damage. He needs to stop what he's doing and get back to Tesla. What's your position on the roller coaster that we've been on?
Well, I said recently to the Guardian newspaper that I wish that Elon would spend, and I chose my words very carefully. I said, I wish that Elon would spend less time on Doge so that he could spend even more time on his outstanding companies. And I emphasized even more. I don't think he's missed a heartbeat in terms of Tesla. And I mean, Ron Barron is in contact with Elon quite a bit, and he's commented publicly. It's amazing how Elon makes all of the meetings. He doesn't miss the meetings. He's fully engaged. He's juggled multiple businesses for a long time, and that should be very clear by anybody who's read Walter Isaacson's biography on Elon. And so, look, like I think that it would most likely, because we don't know, without looking in hindsight, but it would most likely have been better for him not to be involved in Doge. That's my general feeling. And so I would wish for him to spend less time on Doge. And he is apparently going to spend less time on Doge. But a hyper focus on his involvement in government, I think, misses the forest for the trees. Yeah. I think that there's a lot more going on to this business. I think the market actually sees that, right? The stock is moving higher, despite what some people thought was a disastrous Q1. We actually don't feel that way, but a lot of people feel like Q1 was a disaster. You've had he's been distracted, et cetera, et cetera. The stock is moving up. So I think the market is starting to catch on that, the fundamentals are actually not as poor as they might look. And it's also, I think, too early to tell, what is the effect of his involvement in Doge, if any. So of course we read about the potential brand damage. You don't see very many articles on the customers that he might be picking up in red states. And I mentioned this somewhere recently that of the Tesla Model Y, the pre-refresh model was recently completely sold out in 29 states. Those happen to be mostly red states. So I'm not sure, you have to think about the other side of the coin. What is he potentially picking up? But at the end of the day, again, a focus on some of these things, I think misses the forest for the trees. This is a very strong business and it's a growing business.
Tell me about how portfolio managers, big whale investors, institutional managers, how do you guys look at the transition of Tesla from a car company, an auto business to a, physical AI, robots, robotaxi business? Are they getting it? Are they slowly getting it? What will it take for them to start really understanding this?
Well, I think there are more than a few sell side firms out there that have Tesla within auto, and that needs to change over time. Clearly, the analysts are not schooled in the areas that your audience probably knows a lot more about. And so that needs to change over time. And yet there are other analysts who deeply get it, like Adam Jonas and Dan Ives and Pierre and a whole bunch of other people that get this, and they don't look at it as an auto company. From a portfolio manager standpoint, I think that unfortunately, the vast majority, of course, there are exceptions, and we like to think that we are definitely in that group of exceptions. But there are a vast majority of portfolio managers who think about, first and foremost, what is that the company's weighting in the S&P, and what do I want it to be weighted? So there's a judgment call there, but they start with the S&P weighting. And the judgment call is a reflection, in the case of Tesla, of how much that portfolio manager wants to deal with clients.
Okay.
And
yes, this is, I guess, the reality, right? Yeah.
This is very much the reality.
Gotcha.
It's not so much, can I 10x my investment? It's, what's the weighting of Tesla in the S&P, and where do I want to be relative to that weighting? Most of the time, it's going to be lower than the approximately 1.6% weighting that Tesla currently represents of the S&P 500. And often is the case, it's going to be zero. But that's the framework. Portfolio managers, for the vast majority, and of course, again, there are exceptions, for the vast majority, they don't want to have to deal with answering questions from clients who absolutely hate Elon, or who read that something awful is going on with the business and wonder why you still own it, right? I've recently spoken with a portfolio manager, and he said to me, I hate Tesla. Those were his words, I hate Tesla. And I can tell you that he is massively underweight Tesla because because he hates Tesla, first of all, and he doesn't want to have to deal with explaining to anybody why he has that position. So that's how most portfolio managers think about it.
Very interesting.
And Tesla is also, I should mention one more thing. It's a very important thing, Herbert, because Tesla doesn't behave like most companies. And that's another reason why portfolio managers tend to hate it. It doesn't do what they expect it to do. So we do a lot of research, of course, not just on the fundamentals of companies, but some of the more idiosyncratic areas of portfolio management. And I can tell you that our research shows that since Tesla's IPO in 2010, June 2010, 90%, you'll love this figure, 90% of Tesla's gains have come during 5% of the trading days. So we went back, we looked at the stock splits, of course, we looked at holidays, we looked at the actual trading days. And so 90% of its gains come from 5% of the trading days. So that's just less than 13 days a year on average. 13 days a year. So basically, you wake up every morning as a PM, and what you're going to find during the day is that Tesla is going to be either not doing anything or it's going to be down.
Yeah.
And you better be there to explain to your clients, why do you own this company? It's not going anywhere. It's got all this headline risk. It's got management risk, presumably, right? All of these things you have to deal with. And if you're not there for 13 days of the year, what's the point?
Yeah.
It's just headache. So that's another big reason why PMs don't like to own this stock. They might not know that from a statistical standpoint, but they know it intuitively. It just doesn't behave the way they would expect it to behave. And it drives them crazy.
That's brilliant. Thank you for sharing that. That's always great to hear directly from somebody who knows and talks to these other portfolio managers. So when will these investors, the big whale ones, start to really think of Tesla as a physical AI? You have said that you see its optionality, but then you've done your research. I mean, you walked me through, your metrics. You've calculated what you think very conservatively, but still you did it. Robotaxi. I'm sure you've done one for robots. When do you, because you already see Tesla as an AI company, you already talked about that, but what about these other portfolio managers? When are they going to finally clue in that this is what the real investment is? Is it until earnings show up and, second half of 2026, 2027, and they actually see increasing sequential quarter-on-quarter earnings release? Is that the only time, really?
I think that yes, I think that the earnings have to show up. Why do they have to show up? They have to show up because the PE ratio has to come down. Okay. So the PE ratio needs to come into a range, which is easier to justify. Right. And if the stock is 5 or 10 times higher at that point, and the PE ratio is now 30 or 40, then they'll be very happy. And I'm not joking. Like that's how people will think. They'll be happy to buy it at that point.
Yeah.
And for anybody who doesn't think that's how most, not all, but most PMs think, I have a very good friend who is a great investor, and he was early in Amazon. And he got hate mail because he bought Amazon, and he's a so-called value investor, right, as we are. And, now pretty much every PM owns Amazon, and it's considered a quote unquote blue chip, right, of our time.
Yeah.
Tesla will be.
It's interesting you called it your value investor. How could you be a value investor? I mean, I saw your introduction and your description of your company, and it does say that you look for safe investments that have growth potential. So you actually, which this is right in line with retail investors. We actually do look at Tesla as a safe investment, surprisingly. Look at the cash flow, look at the strength in the market, the products. But you called yourself a value investor and investing in Tesla?
Yeah. I mean, so all intelligent investing is value investing. Value investing means getting something for less than it's worth. Microsoft, when it went public at a relatively high multiple. Amazon, when it went public at a seemingly high valuation. Typical value investors would not have bought those stocks.
Right.
But by definition, they were like deep value stocks because they've compounded at such high IRRs. So we think about, if, again, it's not about the multiple. A company is not valued based on 1 year of earnings. It's valued based on all of its future cash flows.
There you go.
Right? Discounted back to the present. Yep. And again,
future cash flows. Okay.
Future cash flows discounted back to the present. And if you invest a lot of money now, you might be depressing current earnings, current cash flows, again, creating a higher P ratio. So you could conceivably have a company that is selling at a 100 P ratio or more, but at a 50% discount to its intrinsic value. You can have a 200 P ratio stock because P, again, is price over earnings. It's 1 year of earnings. If earnings are depressed that year, the ratio, P over E, will be very high. But that's not telling you anything about the next 20 years of cash flows. So you can have a 200 PE multiple company, and that stock could still be at a 50% or more discount to intrinsic value. So it could be a value stock. Yeah, so every company we look at, we only buy if we think it's a value stock. And so hence we're value investors.
I'm liking Tsai Capital, but you're so different. I'm telling you. That's why I'm like, what? Because I'm listening to other portfolio managers, and they do not look at future cash flows. They look at the next 12 months, and this is what they focus on. So
yeah, it's really, really idiotic because, it doesn't mean that there are any cash flows past the next 12 months, right?
Yeah, and they shut it down naturally.
You could have a great energy drink business that is just doing phenomenally well, and it's selling at a P of 8, and it's value stock for some reason, but maybe it's the product doesn't exist in 3 years and there's no more cash flows. So it's not a value stock, right? You got to look at all of you have to have a view on the future, not just one.
Is there anything that Tesla's doing that you disagree with, or you'd recommend if you were on the board or anything like that?
Well, again, I don't see a net benefit for Tesla shareholders if Elon is involved with the government. If Elon is involved with Doge.
Doge specifically, I know. Because obviously the government, he's helped with the, I'm sure, national framework for AI, robotics, all that's going to be very, energy.
For sure.
He's trying to do something with tariffs, but yeah.
His involvement in government is clearly something that we should all be very excited about, because the potential value creation there is substantial.
Next 6 months, catalysts, near term. What are you thinking about Tesla? What?
So I actually don't think in terms of catalysts, because we go into owning businesses for such long periods of time. I used to work for Mario Gabelli many, many years ago. He taught me so much. And one of the Gabelli framework includes this idea of a catalyst, because they're thinking in terms of what a company's private market value is, what the stock is currently selling for, but what is that catalyst that gets you from A to B? And I'm looking at dynamic growth businesses that are constantly changing. So we're thinking about potential outcomes, be it 10, 15, 20, 25% rates of return, what the base case is, and are we comfortable with that base case? But we're not thinking so much about catalysts. And even if I spent all my time on catalysts, based on the statistic that I read you earlier, that 90% of the gains of the stock come during 5% of the trading days. I mean, what's the point if I know what the catalyst is? I'm still not going to know when it's going to come.
Gotcha.
Right. There's a difference between the catalyst and the timing of the catalyst.
Yeah, good answers. And then I don't think we talked about robots yet. Have you done something similar like that? What you did with Robotaxi? Your modeling for that?
Still working on on Optimus, and but that's clearly Elon's most exciting potential value creating business based on his comments. So. Too early to tell, but it's another vector, right? Another vertical that can drive the IRR higher. And we're getting that for very reasonable valuation today, because we're not paying for it.
So this is your top investments. What are the others that you're, as part of your portfolio, that are the first 5 or something like that? So
we bought a company called QXO, end of July of last year. So we paid a little over $11 a share. This is a really interesting company. There's a gentleman by the name of Brad Jacobs, who is based in my hometown of Greenwich, Connecticut. And I've known Brad for about 25 years personally, because not only has he been a very close friend of the Tsai family, but you might your audience might be familiar with a company called United Rentals, which he built after he built a company called United Waste. And my late father was one of the original investors in United Rentals while it was private. And the whole company was started for roughly $5 million initially, just like his family. And my father was in there and a few other people, like 5, 6, 7 people.
Yeah.
And then they raised a little bit more money after. I think the total was just under 15 billion of total capital that went in. And you've seen what Brad's done with United Rentals.
Yes.
So I had a very early seat at the table to try to watch him and see how he operated. And from 1997 onward, the company went public in 1997. And then in 2011, he took over a company called Express One Expedited Solutions and created XPO Logistics out of that company. And so I watched his whole career trajectory with XPO as well. And he exited XPO in the various spin-offs over the recent past couple of years or so. And he's been focusing on a new business. And that business is now called QXO. It's publicly traded. So QXO is going to follow, in my opinion, a very similar playbook to United Rentals and XPO. It's going to consolidate antiquated industries that are much in need of technology and improvement and the integration of AI in the business. These are, in the case of QXO, it's focusing on building products distribution. So this is like a gigantic industry, right? Around it's global. There are 3 areas. So if you think about residential, commercial, and infrastructure, these are 3 areas that the company will be targeting. And there are about 20,000 players around the world, 7,000 in North America, 13,000 in Europe. And Brad will scale, I think, this company a lot faster than people think. Because I've seen him build United Rentals, and I've seen him, and so I got familiar with his pace, like his really, really fast pace of successfully building and integrating companies. And then I was prepared for that when he did XPO, but he wound up doing it even faster than my knowledge of his history made me believe he was going to do. And so I think that he's just going to build QXO very, very quickly and make it an industry leader. His target, by the way, is 50 billion of sales within a very short period of time. So I think we're already moving in that direction with the acquisition of Beacon. And I wouldn't be surprised if there's another acquisition coming up, with sometime within the next six to 12 months, something of size. And then he'll integrate and he'll build organically and improve the operations.
Sounds like you like founder-led companies, entrepreneurs.
Yeah, I definitely
innovation.
have a preference. Definitely have a preference for them. I like companies, more importantly, that have where the people have skin in the game. The management team has to have skin in the game. I like companies that management has not just been given that equity through the issuance of stock options and restricted stock, but has actually put real capital to work. And Brad and his family have put $900 million into
their own money.
QXO. So that's our second largest position today. And I think that this is a very interesting 10-year play.
Nice.
And by the way, after 10 years or so, he gets bored. So
he moves on anyways.
He moves on. So he likes to accomplish everything that he can. Everything he feels like he can accomplish.
Get things done fast, move fast. Fast is important. And that's where we're going. Any last comments on Tesla and Elon and, as an investment and things like that?
Well, So I think that, as there's so much negative information on Tesla, right?
Mm.
And your audience seems
Yeah.
to have a much deeper understanding than typical Wall Street analysts and institutional investors and PM. They get it. One of the things that is an argument that is often used against Tesla and has been used against other companies
Mm.
is the following. It drives me crazy. The argument goes something like this. Tesla is worth more than all of its competitors combined. How
Yes.
ridiculous is that?
Right.
Okay. So I wrote a paper called Investing in an Age of Disruption. For lack of a better title, I had to come up with a title.
Great title.
So that's the title. And it's on our website for anybody who might be interested in reading it. It took me a long time to write. I'm pretty happy with it. There might be some areas that um, people disagree with or not, but it's how I approach investing, how I approach diversification, how I approach thinking about investing in disruptive companies, and how I approach bear markets as well. So it's all in there. But one point that I do make is that this is a crazy argument. The company should not be worth all the competitors combined. So what people are effectively saying who make this ridiculous argument is that the company A, as represented in the numerator, should not equal more than B, C, D, E, the competitors as represented in the denominator. But then we need to ask, but why not? And so, Herbert, you mentioned, hit the nail on the head. Company's value is based on its future cash flows, right? So if a company is disrupting, let's call it Tesla, is disrupting incumbent players.
Yeah.
It's represented by A in the numerator, right? It's grabbing market share in a profitable way, and it's riding a tailwind, right? So the cash flows of A should increase. And so the value of A should become larger. The present value of those cash flows will increase as the business scales. The value of A should be larger, whereas the companies that are getting disrupted, B, C, D, and E, their cash flows actually go down, right? So their value should actually go down. So in fact, the opposite is true. When you have a successful company that is disrupting a legacy business, A gets more valuable, B, C, D, and E in the denominator gets less valuable. And as we know, fractions increase exponentially as the denominator trends toward zero. And so that was the case made with respect to Apple in 2007, where people made the same argument. How can Apple be worth more than Nokia, BlackBerry, and Palm combined? It makes no sense. But in fact, it makes perfect sense. You just have to think about businesses in terms of cash flows and not PE ratios. And thinking about companies in PE ratios really can make you just not understand the underlying reality of things.
You're brilliant. I love this. I'm going to check it out. A great title for a great paper. Maybe it's a book you should write. But I interviewed Nicholas Colas, legendary investor and the auto industry expert. He was shown that chart. And he said, why is it that Tesla is worth more than all the 12 competitors combined? He did something very simple. He goes, alive, dead. I was
so he's smarter than I am because he can crystallize that thought much easier, right?
In a second. dead. It's like, that's it. That's all it is. That future cash flows over time. The market does not believe that those companies is going to make it and survive. And that's why why is GM only priced at this much? Tesla's car business should be priced the same as GM. Well, no, it's because investors have recognized that GM won't survive, and so they've already lowered their, their willingness to give it a market cap of some sort. So,
yeah, totally right. All that's the nature of reality: alive versus dead. And Schopenhauer, the philosopher, said that all truth passes through three stages. First, it's ridiculed. Secondly, it's violently opposed. And then lastly, it's accepted as self-evident. We're in that kind of second stage now. And when we get to the third stage, and Tesla is much more valuable than it is today, much more investable because it might be up 10x, but the P is at 30 or 40, then the PMs will buy it.
This is such a, see, by the way, that statement you just made is very perfect. That's a perfect, clear, concise answer to the answer of why PMs take so long to answer. So you and did your own
PMs, but many PMs.
Yeah, I get you. But you did your job there. Thank you. That was perfectly crisp of explaining that.
And you can't blame them. You can't blame them because it's just too hard. I mean, who wants to spend 95% of the year dealing with a stock that's flat or down and talking to clients?
Wow. Okay. Well, Christopher, thank you very much. That was a fantastic conversation. Honestly, just very, very, the company, your stuff, and highly recommend Tsai Capital. Go there, go check out the website, TSAI CAPITAL, tsaicapital.com. Christopher is on X at Tsai Capital, Oh man, this was great. I'm going to be taking a lot of snippets out of here. It was very good. Thank you so much for sharing your knowledge. Appreciate your time. Thank you.
Thanks for having me on and part of such a great audience. It's really nice to speak with presumably mostly Tesla lovers here.
Yeah, mostly.
Which is a nice change.
Yeah, and we appreciate it when we get to speak to somebody like you who can really explain it from the side. Like, we get retail, but we don't understand portfolios, institutions. We don't know analysts. We're trying to understand how others think. You described it really well.
Thanks so much, Herbert. Yep.
Bye-bye.
Thanks, everybody.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.